Welcome back to our day 2 of the annual Fintech conference, together organized with the BPI, Brookings Institution, Columbia, U of Cambridge, and the Wharton School. So we will start with 2 sessions back to back, so there will be no break in between. So the first 20 minutes, we are going to give you a really quick review of what talked about yesterday, and also the 3 co-organizers who were not speaking yesterday have actually a lot of fintech activities that they would like to share with you. So so after a quick overview, you will hear from Chris Feeney from the BPI. Chris will talk about the AI request for information that the agencies actually have released to the public. Then Trish will talk about cybersecurity. She has been working on this big project and also has colleagues from who understands very well national security from military at Columbia. And then Raghu, and also Trish also has been talking to various regulatory agencies, many people working on this topic. So she's very well aware of what's going on in the industry and academic. Then Raghu is the academic director of the U of Cambridge Center of Alternative Finance. And they are about to launch this big fintech data platform that they would make available to the public for free, right? And so, so Raghu will show you all what are available in the database and how to quickly how to navigate. So just quickly, yesterday, basically, we started with the OCC controller whose speech was not too different from what he said at the American Fintech Council. So basically level playing field, banks, non-bank, neobanks, and crypto. Then also a lot of topics that we touch on, open banking, buy now, pay later, crypto, stable coins, CBDC, and all the speakers basically touch on or focus on consumer data, consumer rights, consumer protection, and also trust was mentioned a lot yesterday. So it's very important. Many interesting sessions. So and also we have very different perspectives. So for example, open banking, we heard from lawyers, bankers, the BPI and American Bankers Association, but also we heard from technologists, Feeney, Intuit, for example. Also from fintech investors' perspective, from venture capital ventures and for NICA. So I think we are very well, and not all the arguments actually agree. So that is makes it more interesting. Now, also, I think the key things that I took away is that there are lessons to learn from Europe, and so we need to be effective. We need to understand technology, but also to work across agencies to coordinate our policy and requirements and all that. So I think that's just make it quick so that all the other speakers have time. And if there is time left, I'll give you some more detail. So I'll just go to Chris to talk about AI request for information.
Julapa, first off, thank you and welcome back, everyone. I'm Chris Feeney. I run the Technology Policy Group at the Bank Policy Institute. And I want to thank Julapa and the team, actually. You guys have done, again, a fantastic job, an all-star program. So very interesting. You know, it's funny, Julapa, when I heard you say, you know, there's some differences of opinion in open banking, what I actually walked away with yesterday, and for those on the call here, I've been in the aggregation space for years, and I was a technologist. I actually see alignment, and I see these groups coming together more closely. Whether it was the panel that Dick and Greg Baer talked about, representative of the industry, or the fintech panel, which was interesting as well because of sort of how they're thinking about it from both a supplier perspective, but more so how to enable the banking system. I walked away with a few things, some commonality around ownership of the data. And I think unanimously people thought the consumer should own it, improved access. often referred to as inclusion, but the fact that you can get product, services, and satisfy a consumer demand, I think opens up the financial environment for people who maybe wouldn't have access. A real need for standards. We've been pushing that naturally, especially pushing secure API access, something like that FTX is developing in a broad-based consortium, and an agreement, I think, to move away from screen scraping, which to me, when I was doing operating work and then to us as an industry, is one of the more challenging areas, yet reflective of the fact that that approach actually provided some access, but migrating towards more secure, defined access is important. And then maybe the last two things, and that is the use of data in a purposeful way. We used to call it data minimization. So basically take the data that you need and want to perform the function you're performing, but also transparency and specific transparency around that for the consumer. The interagency cooperation that Acting Controller Sue talked about, we're seeing. I think that has changed quite a bit. And then there's a real opportunity naturally for CFPB in their 1033 rulemaking to actually set some standards here, which is great. The thing that I wanted to talk about is, the other place that we're seeing quite a bit of, change is in the artificial intelligence area. We are responding, obviously, to the work that is going on at the regulatory community. We've seen quite a bit of, change that we've been really keen on inside the walls of the organizations where, we've always been data heavy, and that's an important part of what we do. But we're starting to see AI talked about in the form of better results, better credit monitoring, the ability to actually strip bias out of the equation, although explainability and understanding the models that are in use is important to doing that. We're seeing quite a bit of change inside the walls of the fraud shop, for instance, which has always used data, but now can use AI type data in a way that's more effective, more efficient for finding fraud, as an example. Same with AML. We think there's significant improvements there. In the cybersecurity arena, we can use it both defensively and offensively, depending upon where artificial intelligence is applied. It gives you a couple of different avenues to really be more effective in how you combat and monitor the cybersecurity threats that are out there. So in our view, we think it's important. We think it's critical for, again, delivering better outcomes to consumers of financial products. And we encourage the regulators, and, having responded to the RFI that's been put out by numerous regulators and then having discussions, we encourage them to think about the outcomes, not the technologies. And that, we think, will actually lead to better outcomes, more effective use of AI over the periods, course of time, if you will. And, it's sort of an important way for the industry, the regulatory community, and the technology organizations to, again, coalesce, in this case, around AI, to really improve banking, to really improve access to financial services, to really improve the types of products that sort of meet the need of the consumer of today and the consumer of tomorrow. So that might be a great topic for next year's conference. My sense is it will be, and I'm going to turn it over to Trish. And again, Julapa, thank you and your team for having us and for all the work you do.
Great. Thank you, Chris. Hello, everyone. Good afternoon. My name's Trish Mosser. I run the Central Banking Program at Columbia's School of International and Public Affairs. And I spent quite a bit of time in the last few years working on cyber risks and finance. And so that's going to be the focus of my comments. It's a real pleasure. Let me pause and say it's a real pleasure to be here today and to be associated with this conference. Hats off to Julapa and the Philly Fed again. So in the last few years, both cyberspace and the financial system have definitely become more complex. And one example of that greater complexity, of course, a topic of a lot of conversations yesterday and today, is that traditional regulated financial institutions have become much more interconnected with innovative fintech companies, both from a business perspective and from a technology perspective. One could say the same thing about financial markets, of course, which by their very nature are highly, highly interdependent, but they also have become more technologically interconnected and increasingly dependent dependent on digital platforms for execution, for analytics, and so dependent on all the companies, IT, fintechs, data providers, communication networks, and so forth that provide critical services. So this is a pretty different world from the one that not so long ago, where cybersecurity and a CISO's job was about protecting the enterprise, meaning protecting the IT assets of a firm. But that's clearly not sufficient anymore. In a post-SolarWinds world, it's pretty clear that all types of firms, not just IT and software companies, should be taking a much broader view of their cybersecurity risks. And I would make the case that looking beyond the firm, as I call it, is particularly important in finance. Because financial companies are highly interdependent, always have been, and interconnected from a business perspective. And they are increasingly interdependent from a technology perspective as well. A few years ago, my colleague at Columbia, Jason Healy, wrote a paper at the Atlantic Council that called for cyber resiliency and risk management at individual firms to look beyond the enterprise, as he called it, and focus on, his terminology was on pools of cyber risk that might affect their businesses. What he meant was to assess cyber risk of a firm's dependencies, digital services, counterparties, vendors, and all those sorts of things. Right now, his point seems particularly relevant for financial firms because the complexity of digital finance has exploded, is the only word I can think of. COVID has accelerated trends that were already well underway. And the interconnections across the digital finance world between banks and fintechs and cloud providers and API providers and data providers and more vendors than one can keep track of just continues to increase. This conference, quite rightly, has spent a lot of time discussing how this explosion in digitalization of finance has brought about a lot of improvements in financial efficiencies, lower costs, increased access to financial services, greater openness, inclusion, and so on. But one of the costs of these innovations has been an equally large explosion in cyber risk. And cyber risk that is what I call systemic, meaning it isn't contained to individual companies. And so such pools of cyber risk are increasingly important to monitor and to manage. And to do so means that firms are going to have to start to make assessments of cyber risks that are far outside their own perimeters. A couple of obvious examples. The vast expansion in cloud computing, for which in the financial services industry is concentrated in a very small number of vendors. Now, let me be clear here that cloud provides a number of cybersecurity benefits. I want to be really, really clear. But I want to be equally clear that financial services are increasingly putting all their eggs in one or two baskets here. That's fine. It's safer. But then that means as a firm, you really need to make sure that you watch and risk manage that one basket really, really, really well. Another example, of course, is the large increase in APIs for transferring data between financial companies. That's a clear case where cyber risks for an individual company now go far beyond the perimeter of that company's own IT systems. So in my view, the increased complexity of the digital interconnections makes it more likely that at some point in the future, everyone will be exposed to the same cyber risks, potentially at the same time. And to repeat a point I think that a couple of others have made, this is a global risk. It's not just a risk within the United States by any stretch of the imagination. Now, I say all this not to purposefully make people nervous, but to point out that this is a big challenge that should be addressed. If we wish to continue to reap the benefits of the current digital revolution in finance, attention to cyber risks is important. Let me close by saying that this is a challenge not just to, I've talked a lot about the individual firms here, but this is a challenge not only to private sector companies, but to the public sector as well. And the role of public policy here is really, really important. Both national security policy, obviously this is about cyber risk, so you can't ignore national security policy, and of course, financial regulatory policy as well. The good news, I think, is that better management of cyber risk is an area where the incentives of the regulators and the public sector is actually pretty well aligned with the incentives of private companies. It seems to me that this points to a few ways to start to make some progress. One way is better coordination across the official sector, including financial regulators on standards and requirements and so on, along the lines of what Chris was talking about a minute ago. Not just in the U.S., I want to say, but globally as well. Secondly, improve communication and information sharing on risks across public and private sectors. For cyber, this is difficult because it's really sensitive information after all, but it's not an insurmountable problem, and there are a number of advances that have been made in the last few years. And finally, as I've been discussing, financial companies really need to accelerate their shift from sort of looking just inside the firm, IT risk management, to cyber risk management that focuses on the risk posed by the entire ecosystem, technology and business, that supports that firm. Thank you.
So thank you very much, Trish. My name is Raghu, and I am the academic director for the Cambridge Center for Alternative Finance. So what does alternative finance mean? Well, it's kind of like we thought as a catch-all term for anything which is carried on without going through a traditional financial intermediary, like a bank, a mutual fund, things like that. So one of the things which AI needs is, for example, data. So one of the purposes of the University of Cambridge CCAF is to produce that data. So what we've been doing in our center is coming up with public access data, which tells us about how the finance system ecosystem, financial fintech ecosystem is evolving over time. Take one example, the alternative lending space. The traditional form of lending, which all of us are familiar with, is going directly to a bank or borrowing money from one of these traditional institutions. However, what about borrowing money directly? If you're a company, borrowing money directly from individuals, what we call direct issue bonds. If you're an individual, borrowing money directly from other people, what we call crowdfunding. Is this a valid form of transaction? I mean, you might think that, okay, this seems to be marginal. We're not really, this is not a huge deal in the marketplace. So we actually collected data from over 3,000 platforms all over the world to see how much volume of funding these guys did on an annual basis. We've been doing this for several years, so from 2015 onwards, and we have charted the way these things go across the entire world. So let me start by sharing a little bit of my screen to give you a sense of what the data we collect looks like. So what you see over here is basically our basic database. It's not yet completely ready for public consumption, but this is what we're planning to evolve over the next 2 months or so. It'll be open to the public. Let me start by looking at what we call alternative finance benchmarks. So what you see here is looking at how do you raise money across the world without using a bank. So if you look at, for example, types of ranking, you have digital lending and digital capital raising. Digital lending is directly lending to individuals or companies without a bank being involved. And if you look at a map across the world, it's pretty much everywhere. So the data goes back from 2011. It actually started out in the UK, spread over to Europe, went all over the world. And interestingly, if you keep noticing, China becomes darker and darker until in 2018, the government almost bans crowdfunding in China, and then China pretty much disappears after 2020. So the global ranking comparison across the world is not small. So in the US, for example, last year in 2020, $70 billion of funding was raised through crowdfunding platforms. That's a significant number, nothing compared to what the banks do, but it's much larger than what you would expect it from other, without any, if you don't have any prior conception. The second largest was the UK with $5 billion. China, 2 years ago, was dominated the world. It was $214 billion of crowdfunding, shut down completely by the government, dropped to about 7 in the sample with less than $1 billion, about $1 million worth of financing today. Digital capital raising is another form of alternative finance. So, for example, this involves things like, what would replace venture capital firms, unlisted firms raising equity capital, raising reward donations, and these are also quite substantial. Again, not very large. You'll see about $6 billion worth of financing in the UK, $3 billion worth of financing in the United States, but community shares, equity crowdfunding, donation crowdfunding, these are significantly large numbers. More interesting is one factor I want to talk about, which is related to how the business or the finance world itself is changing. The finance world today has been almost overtaken by, I guess it would be a fascination for what we call decentralized finance. Decentralized finance is you're directly dealing with peer-to-peer, again, like digital lending, but this is through an application which allows you to run any kind of smart contract you want, completely cutting not only the financial sector out of the way, but also the legal sector. For example, you may be completely familiar with the craze for non-fungible tokens. Non-fungible tokens are an extremely innovative way of converting an illiquid asset into a liquid, tradable asset, which you can then use to trade on the marketplace. You created value from nothing, but there are costs as well. So the cost we look at is how much electricity it takes to consume. It consumes by mining these kind of tokens, or in this case, Bitcoin. What you can see is currently we have a chart over here which shows you just how much the Bitcoin power demand is on a daily basis. When you run comparisons, one of the interesting things is if you look at the country ranking, Bitcoin is about 120 terawatt hours per year, as opposed to the Netherlands, which is about 111 terawatts per year. So Bitcoin mining alone consumes more power than, say, the country of the Netherlands. However, the problem is, how do we account for this when we have the problems of climate sustainability and all these other climate change issues? The problem is, it's not easy to calculate because the cost of mining
Raghu, sorry to interrupt, but we have taken 2 minutes of Cross River Bank's time already.
Thank you. Sorry about that. So basically, these databases will be open to the public. They're open to anyone. And so feel free to download them starting, I believe, in January 2022. Thank you very much, Julapa.